Hey guys, if you want to gather around and sit, so we can start.
Someone that knows how to buy, like this guy, and say, okay, what are your fees? Make this place in front. That would be interesting.
There's a RFP on live on scene.
A live RFP, that would be amazing. And imagine like, no, and have something like an AI judge, and whoever wins gets like a 10 million allocation.
Would be good. But no, but how loud people clap.
Yeah, but the thing is like whoever has a token will win.
Hi, Kami, how are you?
Hey,
It's been
how
a
are
while.
you? Yeah. Hey.
Testing, testing.
Test.
Guys, we're going to start the panel. I don't have any gravitas. Yo, boys.
Please start drinking alcohol. It's too late.
Yeah, it is.
Attention
This
span
is
is
like,
gone.
Yeah, it's like 9 p.m. After 4 days of conference plus 2 days of stable summit. Yeah.
Will probably be the last panel ever, like in
I
EthCC.
know someone who's
Of every Brussels EthCC.
Everything, yes, like,
No more EthCC
no more
brothers
panel
than
ever.
Brussels.
There's
Ever.
only the panel to end it all.
I think that's a good introduction. It's actually a good introduction.
Woohoo! Woohoo! Okay, people come sit. There's a panel happening.
Thank you, Seb.
All right. Okay, here we go. Second and last panel of the night. We were just saying this is likely the last panel for EthCC Brussels total. So congrats everyone, you all made it.
Take a shot every time someone says yield.
Promise to make it a fun one. Okay, so this is RWA panel. I'm Cami Russo, the founder of the Defiant. Again, the best source of DeFi and Web3 content. And I will let panelists introduce themselves and their protocols.
Awesome. I'll go first. Martin, CEO and founder of Mountain Protocol. We are the first permissionless and regulated yield-bearing stablecoin. What that means is a token very similar to your USDC or USDT that you're familiar, with the only exception that every day you get rewards simply by holding that stablecoin. And our vision for building that product is this is a great primitive in order to build a real-world use cases, and especially use cases that are catered to those who are targeting very safe, very predictable, large volume investments in crypto. So a building block to enable kind of like the next wave of assets, not just the 6 assets that people will talk in the last panel.
Hi, my name is Lucas. I'm the co-founder of Centrifuge. We've been thinking of how we use or make DeFi usable for assets that aren't just crypto native kind of utility tokens, but go into private credit, public credit, really like not just thinking of like, okay, how do you bring a token, like what is a token on chain, but how do you give it utility? How do you kind of automate the processes behind it, right? When you think of like a financial product, there's so much more than just like how do you track ownership of it, but like how do you manage the cash flows, etc. We've kind of started this together with Maker, which I'm very happy why I'm here, or that I'm here tonight. In the early days, kind of working with some of the first real-world collateral that Maker had, and over the last couple of years have kind of grown this. I really believe that every asset in the future will be tokenized, and the most efficient markets for most asset classes are going to be on an open public blockchain in protocols that are as transparent and permissionless as possible.
I'm Mark Phillips, one of the co-founders at Stakehouse Financial. Stakehouse Financial is a Web3 crypto-native consulting and advisory firm. We do a ton of work with DAOs and various crypto-native businesses. We do a ton of work with Maker and Spark, Lido DAO, ENS, Morpho as well. Yeah, really excited to be here and talk to you guys about RWAs.
Awesome. I have a follow-up question for both of you. For Mountain, so you mentioned that USDM is a stable coin that is yield-bearing, but that you also want to enable more of the long tail that we were talking about in the long panel. So how do those two things go together?
Yeah, so if you think about like TradFi, when you deploy money in TradFi, anything that has working capital or escrow capital or anything that is sitting in someone's balance sheet, that usually is yield-bearing, and usually that investment is held in very short-term sovereign debt. So what that means is essentially kind of the risk-free rate that the people denominate. That asset is very hard to get on chain, right? And instead of accessing that asset, we looked at proxies of that asset, right? So secure lending is kind of like the comparable asset. People refer to the AVA rate as the risk-free rate. But in many cases, when you want to bring real cash flows from insurance companies, from remittance companies, from kind of more traditional flows, explaining AVE to those people is going to be very hard, and scaling those cash flows, predicting what those cash flows are going to be, et cetera, doesn't really work. Generating a token that looks like what those people have been using is way easier. And to give a practical example, there is already several companies that insure real-world risk. So, for example, there's a Florida hurricane risk policy issued by a regulated Bermuda entity. And in the back of that policy, there's USDM collateralizing a portion of those claims. And the reason you need USDM is the premium that is paid essentially by the condo owners in Florida for that premium is about 7% APY. You're never going to get people to give you money for 7% APY when they can go at 5 for the US Treasury. But if you get 7 plus 5% that is provided by USDM, you're now in 12. Now you're competitive to TradFi. Actually, you're better than TradFi. And essentially, you can convince TradFi Capital to actually purchase these policies on chain. And then you have all of the advantages that you get on chain. You get lower cost of operations, you can sell to more people, like you get all those advantages that we know, but you need the primitive in order to couple insurance premiums plus risk-free rate in order to repackage a product.
Okay, so you can attract a greater diversity of lenders by providing this additional yield that you get from, what, US Treasuries or?
Exactly. It's the same yield that Circle or Tether get, but they don't give you. So the only thing we do is we give it to the holder as opposed to keeping it ourselves.
So why do you think, so Tethers is able to generate billions of dollars in revenue by keeping the yield for itself, and it's still the largest stablecoin. Why hasn't a DeFi native stablecoin that actually passes its yield to users been able to meaningfully erode Tether's market cap?
Network effects. So essentially, the rational thing to do would be, let's say you don't like USDM, whatever. If you have something that's constructed exactly like USDT but pass you the money, you should individually go and buy that asset. The problem is with stablecoins, you're usually using that money to do something, right? You're paying someone else. Does that person accept USDM? And getting those network effects to go is hard. And essentially, the laziness of adapting to a new network is the reason why USDT, USDC are able not to pass the yield. And to give some other examples, right, like GBTC on the Bitcoin ETF, they rely on lazy money.
Right.
They charge 2%, whereas everyone else charges 20 bips, so it's 10x different.
But they were first, they have network effects, so it's harder for people to make the switch.
Yeah, and most people are lazy, right? Like the 3 billion of DAI that are never going into the DSR, although it is obvious that they should. Another example is in Bank of America, right, or JP Morgan. There's people getting 0 on their deposits where they can turn around and go to another FDIC-insured bank and get 5%. So this is something that we see on and on in crypto economics. In economics in general. People are lazy, especially retail, and a lot of
money is left on the table.
A lot of the money is left on the table, and a lot of people use that money in order to make a business model around it.
I mean, maybe just to add something, you see this in TradFi happening as well. I mean, when Chase is still not, I have a bank account with Chase, and I asked them recently what their like a deposit rate is, and it's still basically zero. I mean, the banker's just like trying to avoid an answer, and I said, yeah, well, like, don't worry, I'm just going to move all of my money into yielding short-term treasury bills anyway. I'm not going to leave any with you.
I actually checked for the Stable Summit presentation. Bank of America, for your savings account, pays 3 bips.
Yeah, and you can make 5 off-chain, 500 bips, yeah, 5%, yeah, we can make 5%. Exactly, right, so money is sticky, unfortunately, both off-chain and on-chain. And like you do see, there's like, in crypto, like, yeah, like now the rates changed and we have Mountain and many others that are trying to pass on this yield as efficiently as possible. You have fintechs that try to do the same. They go after like corporate treasuries and say, oh, like instead of having your money with like Silicon Valley Bank or whatever the replacement of that is, now you put it with Meow and you get treasury bill yield. But even that, like not a lot of people do because like how much work is it to change your bank account? So I think, I guess that we've made it when like, and maybe I have a question to you actually. Do you think, like how long will it be until like Uniswap trading pairs will be denominated in SDI or USDM? Because that's when like it gets interesting.
I think for that to happen, incentives need to go away. I feel like the short-termism of like, I need to get my tokens sold, I'll just put incentives to compensate for what Circle is making. So people just sparkle incentives on top of those pools, which make yield-bearing tokens not competitive. In a bear market where those incentives don't exist, or where more mature projects that no longer have a bonanza of tokens, I think that's when the loss of economics actually start to play out and worse products start to switch. So I don't know, I think we need a bear market or time. I think those are going to be the two things.
And Lucas, I wanted to ask your opinion on unsecured lending, which is what you specialize on, and the previous panel was saying, it's too early for that, like we don't have the primitives. So, how are you making it work? Like, what's your take?
So we do both. We do secured and unsecured lending. The difference is actually very nuanced and hard to explain, but I mean, like overly simplified, right? It's like, do you have an asset that you secured the loan with, or do you not have an asset? Giving a company money and saying, okay, like pay us back whenever you have the money to pay us back, generally unsecured. Giving a company money and saying, we're taking your CNC machine that costs $250,000. If you don't pay us back, now this CNC machine is yours in case you don't get paid back, right? So like a loan against some equipment, a car, a house, secured. A loan against something else, like nothing like that unsecured. I think like the fact is like unsecured lending is very normal. Like when I get a credit card, it's effectively an unsecured consumer loan. So yes, like this stuff is not easy to do, and I think it's especially not easy to do in an ecosystem where you don't have strong identity. Like people switch from one address to another, and like legal recourse is hard. So I agree, like we won't like see unsecured lending on chain where like I give an unsecured loan to some other ETH address that I don't know, but like the unsecured stuff that we're bringing on chain, I think that can still work, right? Like it's kind of taking those firms that know how to do consumer lending and giving them DeFi rails as opposed to expecting them to do it in a TradFi way. I think that can work. Maybe in the future we will see someone being able to get a loan simply because their ENS name has a rich trading history and people think, yeah, like this person's probably going to pay me back. I agree though that is like where it's still too early.
It's kind of what happened with Alameda though, and why all the CeFi lenders blew up. Is people were like, oh, these guys make so much money. They have FTX, they have the exchange, nothing bad will happen with them. And then shortly after, everything fucking blew up. So.
And then it happened with the Austrian real estate magnate that Credit Suisse lent money to, and Credit Suisse blew up.
Yeah.
It does happen.
Yeah, so I think we need to go quite a bit further with the sophistication of the DeFi before we can start dabbling with unsecured lending again. We've already made quite a few mistakes, and thankfully Maker and other DeFi protocols have taken a pretty conservative approach to how they manage risk. And nonetheless, some TradFi media kind of mistook what happened, saying crypto's blowing up again, like crypto's bad, blah, blah, blah. But all the kind of OG DeFi protocols kind of held steady. And that's really what we're trying to do, and what we're trying to build here is a more secure, sustainable ecosystem that's rock solid. And yeah, I think it's going to take some time before we can start doing some unsecured, more sketchy stuff, perhaps.
I think the portion of unsecured that might come in is corporates, right? If you look at banks today, they will hold T-bills, they will hold mortgage-backed securities, but they will also lend to like Apple, they will lend to Walmart, like those guys. I think something like that could be interesting to bring on chain. I know Coinbase is paying like 13%, and I feel many people here would lend to Coinbase at 13%. So I think corporate unsecured lending might be an interesting one to bring in. But I think the key thing we need to take out from our minds is lending is risk-free. I think it's a good primitive to start with, but then we have to start walking in the risk curve, and you might get losses, right? Like companies explode here and there, and that's why you get a premium, right? If you're getting 5, that's risk-free. If you're getting 13, you're taking 8 points of risk.
I mean, I think that the problem with 3AC, I mean, there's a few problems with 3AC and FTX and Alameda, and quite a few of them, but like if you only lend to crypto market making firms, you take a huge like sector risk that like no bank would normally just do. Like you would want way more diversification. That is actually one of the reasons why some of the US banks got shot down, because they had so much cluster risk in crypto that the regulators said, look, like you can't just have all of your customers in one vertical.
But that was assets, not liabilities.
So that was assets, but in the end, right, they can be similar problems, right? Like you have like this, you need to have this diversification, which is really hard in crypto. We don't know yet how to value like crypto market makers and their cash flows, how to audit this. And I actually do think like this unsecured crypto lending asset class market is not even that interesting, because it's actually quite easy to secure it. And I do think, like seeing what Maple did with going from mostly doing unsecured crypto lending to now actually securing it is actually a great step. And it's very easy to get some collateral, right? It's as easy as sending Bitcoin or ETH or whatever to the lender, and which now we're talking about like a lending market like Spark. So I agree. Like we should take some time before we get into that. And
I mean, it's easy if you limit your market to only crypto natives, like people who already have that capital. But that means that you're excluding a huge market who just like does not have that collateral to put up, right?
I think you have to start somewhere, right? So we started on I want to make sure like 200 like loan to value, right? So collateral to loan. So then we started going down, and now you can get like, if it's just your collateral 130% or something like that. What Maple is doing is pushing that a little bit further and saying, we have your money, but we also can take you to court, and that should allow us to take a little bit more risk on the margin. So I think it's a good innovation, and then from there you can start, like it's baby steps, and you're walking down the risk curve. So yeah, I think it's a good construction.
I mean, I would say like, this is the point though, right? Like we are talking about two different kinds of unsecured lending. What you said, we probably shouldn't do unsecured lending against crypto companies. I fully agree with. Someone that wants to finance, someone that wants to get a payday loan or a credit card loan or like something like that, right? Like I think there's plenty of people that know how to do that. Now they're probably not in this room, and the thing that we're doing is we're trying to get them into this room so that they can actually do the unsecured consumer lending, but using crypto rails. And that I think is a great use case, and is not the same use case as saying unsecured lending in like anonymous crypto users or crypto hedge funds and DeFi protocols and treasuries, right? Like that. So I think those are two very different things, because there's a lot of knowledge we have of how to do unsecured lending in the traditional world for the people that don't have cash flows or assets or whatever that they can use.
So stepping back a little bit on just like our RWA market as a whole, right now there is 10 billion in total RWA value. 80% is in private credit, 10% is in treasury. assets, and the rest is in commodities. And this has grown pretty much in the past 12 months from just like a very small size to 10 billion. So it's had massive growth, but it's still pretty small relative to crypto as a whole. So what do you think will be driving growth in RWAs going forward?
Yeah, I think it's just one of those things that's a bit of a slow burn. It takes a while for both financial institutions and regulators to get comfortable with these assets and the technology and kind of how it works. We've had a lot of conversations with different financial institutions, banks, even some regulators about the technology. And I can tell you that compared to 2 years ago, they're light years ahead in terms of understanding of the tech. And once they can actually understand that some of the benefits of the tech in terms of transparency actually provides more visibility than shadow banking and a lot of different financial transactions with banks, then they can start to understand the benefits for actually using this technology. And we're also seeing a lot of different asset managers start to come to market. And once, obviously, BlackRock came, that was huge news for the industry, a really watershed moment for RWAs and tokenization as a space. And these businesses are serious about crypto technology. I mean, a few years ago, everyone was talking about private blockchains, not crypto natives, but people in traditional finance. And now the consensus is completely flip-flops, and everyone's like, oh, public blockchains, that's the tech. And it was like it was so obvious, but 99% of them were saying, oh, let's just do private blockchains, that's the future. No, we don't do public blockchains. But then when you have a $10 trillion asset manager come into the space and launch a tokenized product on ETH mainnet, then everyone else is wakes up and they're like, we got to have a crypto strategy. We got to use public blockchains. Why are they doing this? So I think it's actually a pretty exciting time for RWAs and on public blockchains. And I think we're kind of on the cusp of a lot of big things happening. We just have to get past the hurdles of dealing with the regulatory and compliance regime. But we're very close to, I think, accelerating that 10 billion inflection point.
So do you think growth will come from kind of the big TradFi firms like BlackRock coming into the space?
Yeah, I think it's BlackRock's. I think at the BlackRock's of the world. I think it's their investors. I think people will, fintechs and other asset managers and financial institutions will kind of be like the access point. Their customers will actually, I think, start to use the technology in the back. I don't think they're gonna. I think a lot of them will, start with crypto collateral. They have, a bunch of the new Bitcoin ETF. Hopefully, it's in the ETH ETF. And they'll use that as collateral, and underneath it, it'll be using blockchain tech powering the loans. But there's, a ton of, I think, use cases like that have kind of been held up by regulations that are finally, on the cusp, I think, of actually becoming reality in more friendly jurisdictions.
I think I agree with you. The big milestone was open blockchains are the real thing. Anyone knows that most people believe more open markets will be better markets, and I think that's basically the thing that banks have to learn, that open blockchains are therefore also better markets. I think the thing we're now getting to is stablecoins are finally getting accepted by financial institutions, because it is a very scary thing to hold stablecoins on your balance sheet, know that you might lose them, don't know what will happen if they'll be outlawed. Don't know if you're a publicly traded company, how to report them on your balance sheet, what the auditors will say, right? How it will affect your credit rating. So if you're a large financial institution, or just even a big business, right? There's these hurdles today, they're still quite hard. For us, holding stable coins is an afterthought. For them, it's not. And RWAs, in my opinion, don't make sense if you don't settle on chain, because then you only get half, or actually you'll get probably 10% of the benefit. You get 100% of the benefit when you can settle, because otherwise you always have half of the transaction off chain. So you have all of the trouble that you have with having a transaction off chain still exist. So stable coins being accepted by these financial institutions, being used by these financial institutions, is really, really critical. For example, Franklin Templeton's Benji token, you couldn't actually mint with USDC. You had to wire money to them to mint the token. Sounds weird for us. Franklin Templeton did this for a reason. Now, it's great that BlackRock's actually, no one is sending money to securitize in form of wire transfer. Everyone's using USDC. And that I think
redeem.
To redeem,
Yeah.
So that's a good thing.
Yeah, I would say the main thing with real-world assets is they're boring, right? So you make 5%, you make 10%. Most of the people in EthCC are looking for 50, 60, 70%. And if you think about the use cases of crypto, you have speculation or I want to make a ton of money quick, which is what has fueled the growth to today. I would say that market is big, but it's not enormous, right? In the grand scheme of things, it's pretty small. You have another market that is less represented in EthCC, which is I want to escape from the Argentinian peso. So I'm Argentinian, that was what got me into crypto, and I think most of that market lives in USDT on Tron. And then you have the last market, which is like blockchains are better rails, so it's better to run the same thing that I was doing in TradFi on-chain. And I think that market is more boring because the rates are a lot lower in terms of what you can make. And also it's a lot bigger in terms of the size that you can bring. And the key thing to that is regulation. So if I do this, will I go to jail, right? And I think all of us accept when we pay taxes, wherever we pay taxes, that we do a bona fide effort to pay taxes. But in most countries, there's no clarity on how you would pay taxes. And companies are not going to take that risk. And the second thing is, if I touch this asset that comes from a public blockchain, what are my compliance requirements? Is my chief compliance officer going to end up in jail, yes or no? And until you get that clarity, you're not going to have a flush of capital coming in, and you're also not going to have the stamp of approval for fintechs all over the world to start integrating those real-world assets, the Tesla on-chain, the dollar on-chain, the euro on-chain, for all the consumers to buy. And the consumers are not going to be comfortable that a major regulator has said yes to this, and it's going to kind of be consistent over time.
I mean, in Europe, we've gotten there. In the US, it's looking like we're getting ever closer. So, yeah, it's good.
Yeah, I think
it's pretty bullish on this happening actually way faster than I would have imagined a couple of years ago.
Agree.
Okay, so basically what you all think will drive RWAs going forward is large financial institutions increasingly coming on chain, increasing adoption of stablecoins and integrating stablecoins into traditional financial rails, and more regulatory clarity so that these TradFi large financial institutions can actually do that.
Exactly. So if you think about stablecoins, right? So the M2 of the world is about 100 trillion, give or take. The M2 of the dollar is 20, or 22, something like that. So you have 10 trillion of dollars in the US and 10 trillion in the euro dollar market. The other kind of like non-dollar fiat currencies are like 80 trillion. When the US regulates stablecoins, how much of that do you think is going to go to dollars? And that is all going to be on chain. So you're thinking about trillions of dollars very quickly shifting in. I know my countrymen of Argentina are going to buy that like crazy. Turkey, Lebanon, so like you're going to have a very big adoption of kind of the more boring assets, the stable coins, the Tesla stocks, like a bunch of markets that are going to open that were always closed. So yeah, I'm super excited, and I think we're not that far.
So that's interesting. Like, what kind of assets do you think will be the center of this growth? Because right now, because of the high rates, like there's been a lot of focus on U.S. Treasuries. With rates coming down, like what do you think? Will it be equities? Will it be emerging market bonds, or like I don't know, like real estate?
Yeah, I still think
ETFs,
there's going to
whatever.
be. I think the growth in treasuries is still going to continue quite rapidly because a lot of DAOs and other crypto-native organizations, like the most appropriate thing for them to hold instead of ETH from their ICO 5-6 years ago is like a treasury. Like they're trying to build an organization, a runway to support their operations, and speculating on crypto assets as much as like I love ETH, like you can't have your entire company's assets in ETH riding on ETH. So I still think treasuries are going to be a pretty big market for crypto native companies. I do think there's going to be an influx of new other tokenized assets like corporate bonds, investment grade, like structured finance products. And that's going to kind of give you a little more relative yield relative to treasuries when the rates start going down. And then we're also seeing a good amount of, Athena-like, Pendle-like competitors being built, but just slightly differently, but offering, some slightly higher yields. Not appropriate for, most treasuries and most, crypto organizations, but something for the speculator for sure. And, to the extent that these assets are built, safely, securely, and offer an attractive yield while still being, delta neutral or close to, then that could potentially be, an asset that Maker would look at.
I think short term, you're right. Like midterm, you'll start to see assets come on chain that have a specific reason. It could be because the on-chain market likes them. So like if we all like emerging market lending, then probably that will come next. If we all like US real estate, then that's what probably come next, right? But that's because like this market here, and I think the market that's already on chain, and that is going to start with like maybe commercial papers, some safe stuff that DAO treasures will diversify into. When you like look in the long run, right? Like the largest asset class in the world is private credit. It's also the most convoluted, like not heterogeneous asset class. So like it's not all the same. It's way harder. So that's I think the like long kind of far out goalpost to move towards. But like you ultimately like you any sane investor will start to just simply look at their on-chain assets as part of their portfolio and realize, okay, like maybe I'm gambling a bit too much by being like 90% long ETH and 10% in cash. And they'll say, okay, well, like I probably should put 20% into real estate and maybe 10% into like working capital loans, something maybe more short term. So I have like the long real estate stuff and the short, like shorter maturity loans. And that is like really just a matter of like also this ecosystem maturing, right? Like the fact is like everyone here is like still for a large part here because yeah, we love ETH and we love the roller coaster and we all believe that it's going to go up. And now it's hard then to say, okay, well, but I'm going to sell some of it and put it into treasury bills. But this is what's slowly going to happen. Like buy the DAO treasuries that realize, yeah, like if the bear market comes, we don't want to let half of our team go because we realize half of our money's gone. This happened in 2018. Several projects had really big issues because they kept all of their treasuries in ETH. So I think that's slowly going to happen.
I think the sell side is going to sell whatever the buy side wants to buy. That always is the case. So the question is, who's the buy side? I think the buy side is crypto natives. I think there's certain products for crypto natives, which I think are the ones we all know. There's TradFi. I think TradFi loves Bitcoin, and I think the performance of the ETF shows that. But I think the biggest buyer when you tokenize something is whoever is accessing something for the first time. So which are the markets that by bringing them on chain, you're accessing something like an audience that was not able to buy previously. And I think that is kind of international markets, right? Like the US, Europe are very mature. If you want to buy an asset, you usually can. I think it's the rest of the markets, what do they want to buy? And I think that's where most of the growth is going to come from. So I think still a lot of that is going to be dollars, it's going to be treasuries. And then it may be US real estate, European real estate. And then it's going to grow private credit and so on. So I think that is where I see the big inflow coming in.
So crypto natives, but also newbies who are, wanting to access markets that they didn't have access to before, and so, blockchains and crypto is enabling that access. But what about the whole argument of like, TradFi and big financial institutions being the ones driving growth? So, that buyer then is different. It's like the clients of BlackRock who maybe want something else. Like they don't want US treasuries or dollars, or I don't know.
I think the client of BlackRock today, if they're in the US, they're not going to buy it on chain for now. I think it's going to be the client of the BlackRock of Turkey, right? And who's the BlackRock of Turkey? We don't know what the name is, but once they have that product to sell, if you're a top 10 company in Turkey, you can buy it already, but 99% of the people can't, right? And I think in developed markets, it's very easy to buy. You have Robinhood, the equivalent app, so you kind of have a pretty good access. If you travel to most places, you don't have that type of access. So I think it's the BlackRock of Turkey. It's what is the person, the Robinhood of Turkey, the customer of that, what are they going to be buying, right?
Yeah. Oh, sorry. Do you guys think that if there is a bull market coming, in the next 12 months, that our real-world assets will take a back seat? Does the sector need to wait for another bear market to really thrive?
I can take that. So I think that there's specifically I think there's two answers. Answer number one is if we get regulatory clarity, it doesn't matter, right? Bitcoin at 10K or 100K, if you get regulatory clarity, you open new markets. With the markets where they are today, without regulatory clarity, yes, I think markets today are pretty frothy. I would say we are in a bull market. If you look at where the funding rates are, where incentives are, the splurge and so on. And I think that splurge benefits more greedy or more risk curve kind of harvesting and less of real world assets. So I think that it's kind of got a valid answer in that regard.
I mean, I think we saw a very big change in the inflows into stablecoins, or the stablecoin market caps in general, when funding rates skyrocketed earlier this year, and that is a pretty clear indicator that people went out of stablecoins and into risk on assets, whether that's ETH or staked ETH or like Ethena, right? And so yeah, today the market is still too isolated. So what you're saying is absolutely right. Although I do think, right, I mean, the industry overall has still grown, so I don't think we'll go down much. Actually, if you look at centrifuge TVL, it's gone up, and then in bear markets stayed flat, and it's gone up, and then in more compression cycles it stayed flat. So I do think there is some sticky capital that will stay around. But yeah, there is also a large part of the market that's just going after the biggest yield, and this month it's Ethena, next month it's treasury bills, and who knows what's going to be in end of this year. But yeah.
Yeah, I think if we go back to Bitcoin 70K, go up to Bitcoin 100K, then all the attention is going to focus back on altcoins, whatever's hot, whatever's the hottest point farm and airdrop at the moment. RWAs will probably take a little bit of a back seat, but silently in the background, all the people here that are focused on tokenization, that they're still going to be doing all the work and working toward building something better than the existing financial system. And at one point or another, the valuations of the companies, the tokens for RWAs, they'll go up a lot as well and catch up, especially once we get that regulatory clarity from the first world countries especially. That'll just unlock so much capital that can just flow into crypto and crypto assets. And I think we're very, very close, the closest we've ever been. And so I think it's a pretty exciting time to kind of be in this space, regardless of what's happening with Bitcoin and ETH price. We're just seeing better things happening, more people coming into the industry, looking at tokenization, and it's pretty much up only from a fundamental perspective.
And then, yeah, looking forward, I always like to ask these questions to wrap up. What are you all excited about that's coming up next in whatever you're working on?
I have one very clear thing. I think for the last 5 years that we've maybe had what I would consider real-world assets on chain, the market was too small to have a market. It was very isolated parties doing stuff here and there. T-bills and the kind of momentum you have now is finally big enough where you will see relatively well-functioning lending markets against these assets. I think we'll figure out a way how to do regulated secondary markets for some of these assets as well. So I do think, and this is actually maybe the one big also like stepping stone or like accelerator inflection point in what that lies ahead of us, like actually having a functioning financial market that looks like the traditional markets for real world assets is going to be an even, like make this even more exciting, because like nothing's as cool as having something to do with these assets, whether it's lending, borrowing, or trading. Like that's what financial institutions want. They don't just want to hold it on their balance sheet. And so I think we are at a point where we're big enough to actually do this. We've tried this so many times in the past, and it was always still too early. So, and I think actually we're not too early. I would predict that we'll see like that's something that's we're going to have liquidity for like T-bills and those kind of products by end of this year in secondary markets.
You have some already, so.
Yeah. Very little though.
Yeah, 10 million only. So for me, I think it is connection to the real world. So we are working into how do we make it super easy to get from fiat into crypto. A lot of what we did so far has been making our token available wherever users are. And now what we want to do is make it very easy for the money inflow to go through USDM. So the working capital, wherever that is sitting, whether you're a remittance company, whether you're a lender and so on, can be sitting on USDM for a day, a week, a month that you're moving that money. And particularly I'm excited about all of the on and off ramp stablecoins being built in every market, right? Like each country you go, there is a local team connecting to the local rails, doing allowing us to do a forex with USDM. So what I think will happen is it's going to be very easy for you to get in and out into any country kind of currency and kind of fiat system through USDM, and we're working on that. It's going to come out soon, but we should have very, very good on and off ramps pretty soon with stablecoins.
I'm most excited for the endgame launch. It's been a long time coming, and a lot of people have been working very hard on it for a long time in stealth mode. And I know the community is super excited to share that with everyone. On the tokenization RWA side, I think the lending primitives and the understanding of the tech is just going to lead to much quicker adoption than people realize. And I think we're very, very close. And every day it feels like we get closer. We talk to someone that's one step closer to kind of making that a reality from varying perspectives. So I'm happy to, I'll be really excited when I first start seeing some of these products, regulated, approved, come to market, and just the capital just start flowing in mass, because we haven't seen anything yet.
Interesting. All right, I think just to end on an inspirational note, and to just like think more long-term and bigger, I'd love to hear all of your vision of, what does it look like when the entire financial market is tokenized? Like what's, speaking of endgame, like what's the endgame for RWAs? Or maybe some of you think that not all financial assets should be tokenized, but in any case, yeah, I'd love kind of the long-term vision for tokenization.
I mean, I think it's hard for us to imagine this future. And maybe the one analogy I would bring is like, how much time do you spend thinking about the internet today? I don't think I thought, oh, the internet, like today, right? Like I used it 100, maybe probably 1,000 times today, but I didn't really think about it. And I think this is like, it's going to be the same thing with like DeFi. It's just going to be how we pay, transact, earn interest, whatever. And it's going to be like so tightly integrated into everything we do, the same way like I use my credit card today.
Yeah, for me, I'm a very simple man. So, if I can start sending like all of my financial transactions on chain instead of through bank wires and bank transactions, it'll make my life a lot easier. Like every time I, have to do a wire, I'm like, crypto is actually easier for me to understand. And I feel like that's probably true for a lot of people that are in this room, and also the younger generation coming up. They're just very tech savvy. And I think once we build enough super high quality products in the crypto ecosystem, no one's going to want to leave chain. And even if TradFi products are more capital efficient or a little slightly higher yielding, like I don't move my money back off chain to make 20 basis points of extra yield with T-bills. I'd rather keep my money on chain, and you saw that last bear market too. Like people were lending USDC on Aave for like 1 or 2% yield. They could have been earning 4 or 5 in treasuries. So I think we just have to build an ecosystem of products that makes people want to stay and just keep their capital on chain and keep coming up with interesting and new products.
I'm excited for all the people that don't have access to financial products, and the reason they don't have access to financial products is because it's not profitable to serve them, and crypto brings the marginal cost to serve a customer close to zero. So I think a lot of people are going to get a lot more products, and specifically they're going to get the best product available in the world, right? So whether you're in Uganda or whether you're in Argentina or the US or Europe, you get access to the same exact product. I think it's going to be a highly freeing force, and I think we're going to see a lot of resistance from many of these governments when suddenly you don't have to be buying an Argentinian bond, you can be buying a US bond or a European bond or private credit, or everything is available. So it's going to be a highly freeing for a lot of people.
Awesome. Love to end on that inspirational note. That's why we're all here. Thanks so much, everyone, and thanks, Spark and me.
So very quick announcement for all the RWA enjoyers out there. We are going to be launching a special event with Spark, and it's called the Tokenization Grand Prix. And what this is Spark and Maker are going to be purchasing up to $1 billion in tokenized public securities. And we think this is going to be a massive impact for the industry. There's a ton of things happening in the background that this has been a long time coming. We're super excited about that. We're going to be sharing more details in the next few weeks. We're putting out some press releases with details. So come to Maker with your best deals. Looking at a couple of guys on the panel. And yeah, we're excited to work with everyone that's building these products, and hopefully we can make something super exciting happen. Applications will officially open August 12th, and yeah, we're excited to hear from everyone.